It's been a really pleasing 6 months again for Aventus, and just as a quick background, listed real estate investment trust, we are delivering sector high distribution yields of almost 8% at the moment, quarterly distributions as opposed to 6 monthly, and our tax deferred is about 30 to 40%, so very healthy tax depreciation returns. Currently AVN is actually trading as most of the A-REIT sector is trading under NTA, so we're about, and that's really due to US bonds coming off. We're about 10% under NTA, so NTA is about $2.33, and we're currently trading at sort of $2.10 to $2.11. In my view, that is, in my humble opinion, that's great buying and great value. I bought another $600,000 units myself, and our chairman did the same as well last week through Morgan from your Sydney office at $2.15. I think it's terrific buying between Brett Blundy and myself. We've got 31% of this vehicle. Brett's obviously got the largest stake. I've got about $5 million invested in AVN, and Brett's got about $350 million invested. So we've got a lot of good reasons to continue to support AVN. Listed large format retail, as you probably are aware, is a growing sector. It's a $68 billion a year sector. $1 in every $5 in Australian retail is spent in a large format retail centre, and it is growing faster than traditional retail. And not all retail is created equal. And that's the one quote I'd like you to take out of today, and I'll talk you through some of the stats, because there's a lot of beat up and a lot of media hype about retail in general. Most of that applies to shopping centres, not large format retail. And that's the key takeaway for today. So just on our portfolio, pleased to say we've doubled the size of it effectively in the last 2.5 years. So we listed 2.5 years ago at $900 million. Now we're sitting at $1.8 billion. We've got 20 large format retail centres, mainly on the East Coast, so 92% on the East Coast, which is where you want to be. New South Wales and Victoria is the lion's share of that, given the residential growth population predictions there and the infrastructure that we're investing. And 74% of our locations are metropolitan, which will be a key determining factor for capital growth going forward. So we've got minimal regional centres, and most of ours are in the key metro locations. Just in Sydney alone, in New South Wales alone, we've got $1 billion worth of real estate. We've got half a dozen centres just in Sydney Metro alone. So we control effectively 43% of the Sydney population catchment area, which is something that no other large format landlord has been able to do in the past. So what does that mean? When you're in a dominant position, it means you can get better leasing leverage, which means better distributions and better outcomes for your investors. We can also get some synergies because we're actually building a cluster of centres all around a central catchment. Just on the next slide, the key differentiating point here is large format retail is all about convenience. So most of our centres are large blocks of land. So we've got 1.2 million square metres of land in 20 major road locations. So I treat this as a land bank play, a mini version of Goodman's. But in the long term, a number of these sites will have higher and better uses that will not be large format retail. So if you look at the site on the left-hand side, that's 2 kilometres out from Adelaide CBD. Is that in 10 years' time the highest and best use for large format retail? So that's a 7-hectare site, and it's got 33,000 square metres of building areas. On the bottom right, that's up in Katara, which is just south of Newcastle CBD. And that centre's a $120 million centre, and we've got more land and more GLA than the adjoining Westfield, which you can actually see in the background. So that just gives you a bit of a snapshot. Most of our centres are single level. They're park at the door of the store. So this is good old-fashioned convenience. Lots of on-grade car parking. So as online continues to accelerate in time, convenience, click and collect will become a major factor of our centres. Who knows, we might even have Amazon as one of our tenants in our centres as they're starting to open up in convenient locations. They're all sitting on major highways. Just to talk about the highlights, because it really has been an excellent 6 months worth of performance, share price aside, that's out of our control, but what we have control, we've done a really good job of. So just 3 points I want to talk to you about: leasing, acquisitions, and then development. So on leasing, we've boosted our occupancy up to the highest level of 7 years, so we're at 98.6% occupancy. So that's really pleasing, and it shows the underlying demand for our real estate and our retailers and also tenants. We're achieving positive leasing spreads, and again, if you look at traditional shopping centres, we're outperforming shopping centres on pretty much all of the key metrics. So our occupancy is actually going up. Most shopping centres are coming down. Our holdover rates are less than 1%. Most shopping centres are sort of 6 to 10%. So that means there's a lot of tenants sitting on monthly tenancies, sitting in shopping centres in our portfolio. There's less than half a dozen, and they're for strategic reasons because we're actually looking to develop a site. We're getting positive leasing spreads, so well north of CPI. Again, if you're looking at Centre and Westfield as a peer comparison for shopping centre land, -2 and +1. So well in excess of CPI is well in excess of those numbers. Incentive-wise, we're well under 5%, and that's been consistent over the last 2.5 years. And again, some of our peers are anywhere between 10 and 20% incentives. So these are low capex, low incentives, high occupancy and positive leasing spreads. So all of the key metrics that I look for are really there in our growth, and I think they're going to continue. On an acquisitions front, it's really been a busy 12 months. So we've done $500 million worth of transactions. So Castle Hill and Marsden Park, our major Sydney Metro acquisitions, are performing really well. So we've done 15 leasing deals on both of those assets. As Fiona and a couple of the Morgans team would have seen on our asset tour in December, we've achieved positive leasing spreads. In fact, there have been high single-digit leasing spreads for Castle Hill, and we had 4 long-standing vacancies at Marsden Park that we've been able to fill to get up to 100% within the first 6 months of ownership. So both of those assets are really going well. And we also sold a couple of assets, which is unusual for an external REIT to sell assets, because that means me and Brett as the manager are actually losing fees, but we're doing what's best for the AVN investors, what's best for the long term. So we're trimming off some smaller non-core regional assets, and we're spending more money and investing into larger metro Sydney and Melbourne assets. Just a reminder, it's a highly fragmented sector, so we're number one in this sector, and we only own 13%. So we're at $1.85 billion, and our nearest competitor that's a pure landlord for large format is sitting at $500 to $600 million. So we hold a dominant position. We want to continue to accelerate that position. 75% of the large format centres, and there's about 150 of them around the country, are owned by syndicates or private investors. So it's highly fragmented, and we're going to continue to consolidate. Having said that, cap rates have been compressing. We don't want to be the vendor that's driving that. We'll pay the right price for the right assets. However, we're going to be disciplined in our approach. And we've got a lot of organic growth coming through the portfolio. We don't have to go out there and drive cap rates down. We've got a lot happening in leasing. We've got a lot happening in development as well. Just on the next slide, just to talk about our tenants. So if you look at this slide, the main key takeout is the diversity here. So 87% are national retailers, so there's only a small exposure to independents. So this is safe, it's diverse income. They're some of Australia's leading household brand names. Some of them have been around for 40 to 50 years, and most of them are actually outperforming traditional fashion and apparel retailers. So the most important point there is the second point, that we don't have any discount department stores. We don't have any department stores in our centres. And we've got less than 2% exposure to fashion. All of those areas have been hit really hard and will continue to get hit hard with online and with international retailers coming as well. You'll notice just 2 of those brands, and just to talk about Steinhoff, because there's been a fair bit of press about Steinhoff. So in our top 15, you can see that Freedom and Snooze, Freedom's there at 3%, Snooze is there at 2%. By aggregate, Steinhoff are 9%. A couple of stats on Steinhoff. They released some numbers recently. The short executive summary for you guys and for your clients is that the local business is trading well. You've seen some of those results. It's a $100 million EBITDA business with about 620 stores, 7 different brands. Most of those are actually in furniture. There are issues clearly upstream. We don't know what they are, neither do they, but they're attempting to ring fence the local business. All of the key metrics and the indicators that we look for in our tenants and the health of our tenants have all been ticked and met. So all of their rents are paid on time. We've got 31 of their stores. They're still actually doing leasing deals, and they're negotiating on leasing deals. So 3 weeks ago, we had one of their local directors personally sign as a director's liability on one of their leases. So if they think there's issues coming locally, there's no way their local directors would be making themselves liable. All of the stores are open. all of the stores are fully trading and they're participating in all of our marketing programs. So for them, it's just business as usual, but there's a lot of headlines and there'll probably continue to be headlines. Who knows whether locally it's going to get sold off? If that is the case, there's very strong demand, because with a $100 million EBITDA retail business, that's strong, it's profitable. They've got reasonable margins, and their like-for-like sales growth for the year is about 3%. So Freedom, Snooze and Fantastic, three of their cornerstone brands, have been around for 30 to 40 years. They're Australia's, well-known brands, trading strongly, and there'd be very strong demand from PEs if that were to occur. 90% of the locations of our 31 stores are in metro locations. A lot of those are in our best Sydney assets as well. So we're comfortable, we're relaxed, it's business as usual, and we remain very close to Steinhoff management. Just on the next slide, this is quite an interesting one as well. As I said at the start, not all retail is treated equally and created equally. So the key takeout here, and this is just a bit of an internal leaderboard on like-for-like sales growth. So we're just looking at one measure only, and a number of your clients will be investing in Adairs, Baby Bunting and Beacon Lighting, no doubt, on this slide, and probably actually more. So the average like-for-like is about 4% for our household retailers, which is strong and positive. It has moderated given the housing cycle, and it will continue to moderate. However, our rents are relatively inexpensive. We're at $290 a square metre. Our average occupancy cost is 9-10%. The average rent in a shopping centre is probably a 5 or 10 times multiple on that, and the average occupancy is probably 15 to 17%. So we believe our rents are low and sustainable for the long run. Combine that with the healthy sales growth that these guys are doing, and you've got a pretty good combination. So that's about 65% of our income is coming out of these retailers, and as you can see, there's some strong performers there. Adairs obviously had that's off a low base, so they've completely outperformed the market. And if you look at the underlying profitability of a number of these businesses, even Baby Bunting, which are down on like-for-likes, they're still profitable, solid businesses that dominate their own category. And a lot of these are insulated to what's happening online, because they're big and bulky items. You don't buy furniture, you don't buy bed online. Amazon overseas, their best exposure or best attempt at that is sort of 1% of the entire market. So this is hard to transport. There's real difficulties in getting deliveries and returns, and that's why we're really confident on the future of these retailers and our brands. Having said that, the other 37% of our income is actually non-household categories. So this is what we're deliberately diversifying away from, a reliance on those retailers that are still performing well. However, what we want to do is we want to boost up the weekday traffic. We want to get away from a reliance on just the housing cycle, given that is moderating. And we also want to achieve higher rent growth than we're currently achieving as well. And most of these retailers are actually paying higher rents. So some of the new categories that we've actually introduced, you can just see some of these. So we've got about 60 cafes and restaurants through the portfolio. MAT on those is up 12%. So our food is performing exceptionally well, and we've got a lot more work to do here. This Nines Cafe in Sunshine, for instance, they're paying $50,000 and making $1.9 million in turnover. Some of these operators are having an absolute field day in our centres. There's no traditional food courts. You don't have 60 retailers competing against each other in a shopping centre. This is mainly in your local centre at Jindalee. There's a two-hat chef sitting at Jindalee making over $1 million in turnover. So these are really profitable businesses. We've also started to add in health and wellbeing as well, because we've got flexible zoning that allows that. So we've opened a couple of day spas and a couple of nutrition warehouses. In addition to that, services. So we've opened our first NRMA kiosk, Services New South Wales, which is like the old RTA, which is where you get your licence, marriages, births, deaths, boat licences, etc. We've got 3 of those in the portfolio, and they're really driving a lot of weekday traffic. And our first Australia Post store is actually relocated from an adjoining Westfield in Katara and migrated into our centre. And why did they do that? The rent was a lot lower, and they wanted the convenience of parking at the door of the store and sort of not being lost in the car park. And we're opening a lot of childcare centres, selective with the operators, but we're opening a number of childcare centres as well, just to complement the weekday traffic. So overall, we're in good shape, really pleased with the results.